Welcome to Market Monday from the investment team and the trust department at the First National Bank. We're starting things off today a little differently by looking at the market, and then we'll get to economic data that's coming over the next couple of weeks and look at the interest rate markets. So what's been going on in the stock market? Well, since last October, when we had the actual definitive bottom, can only be called that in retrospect, but this was the bottom of the bear market of 2022. And on this day, on October 13th, there was a consumer price index report that came out very, very much higher than expected. It caused the market to open dramatically down, and that dramatic down open was vigorously rejected by institutional investors, pushed price up to close near the high, and that was a turning point. Although at the time, during that day, there was no way to be able to tell that that was the bottom. That could have been a temporary bottom. We didn't know what was to happen. It's much easier to see these things in hindsight. At the time, that looked like it was a bottoming pattern, and it looked like chances were good that that could have been a bottom, but that didn't mean that anybody could approach that with certainty. So with respect to the future, regardless of all that, it did turn out to be better. There were higher lows being formed. There were higher highs, higher lows, higher highs, which is the definition of a trend. And that actually extended all the way until the end of July. And this is unusual because here's some seasonality. There's an old adage on Wall Street, quote, sell in May and go away, unquote. What that means is there is a historical tendency for lackluster markets during the summer because many of the major players, including families with the kids out of school going on their summer vacation and not paying as much attention to the stock market. You have employees at trading firms and at investment banks and at Wall Street, other firms like hedge funds or asset management firms, and everybody is on vacation somewhat in the summer. There's a lot less order flow, there's a lot less volume, and typically there's less volatility, which is what we saw in the beginning of May. And that all changed in the middle when it looked like, there were some forecasts and just action came in out of nowhere and kept going, and the market rallied all the way up and through the end of July. Then a more traditional pattern appeared because August, September, and October are historically more likely to see downdrafts than other months. March will also get an honorable mention here, but March is not very proximate to us right now with respect to time. Let's look at what's right in front of us. And going into this period, everybody's back from school, everybody's back to work at their desk, they're back from summer vacation, and they're taking a look at what's happening in markets, maybe taking profits on good positions and or maybe selling assets to free up to determine where they want to wind up at the end of the year. So we see this type of a pattern frequently, and it's not necessarily a cause for concern, although the market has come down pretty aggressively throughout August. It does also look like it may just be a pullback in a bigger picture uptrend. So how that plays out remains to be seen. I don't think there's anyone that can accurately call that now with any degree of certainty. But what we can say is, we're seeing things that suggest the probability favors this bullish market to continue. Those things include corporate profits, which across the board throughout earnings season came in much stronger than expected across the industries. And what that is telling us is companies have adjusted to a higher inflation environment and are able to still make money. And that is one of the key drivers of stocks. The others being revenues. Is a company growing sales or profit margins? How much dollars per unit is the company making in sales? These are types of things. Do they have new products coming? Those are the types of things that can, lead to a durable upward movement in stocks. And we're seeing a lot of evidence that companies are adapting well to the new higher cost environment. So with that said, we're expecting an upward market trend to continue through the end of the year, but we are aware that we are entering a time of year where volatility is likely to increase, and we have to remain vigilant and mindful that that's happening, and remember to zoom out and take the longer term view, which we'll close with like we always do. Now, going into the economy, over the next couple of weeks, we're going to get less data than we did over the prior 2-week period, but a lot of this stuff is really consequential. The consumer confidence number will dictate what's the attitude out there, and to some extent predict consumer spending. And consumer spending drives 2/3 of GDP growth. We're concerned with anything that affects consumer spending, so the confidence is a key indicator. We get information on the labor market, on inventories. That's important because building inventories indicates potentially slowing economy, whereas shrinking inventories might indicate that either retailers are buying less inventory from wholesalers or buying more, and then, maybe if retail inventories are expected to grow, maybe consumers are not buying as much from the store, and these numbers will tell the tale as to whether the economy is really going to start slowing or continue at its pretty rapid clip. We'll get GDP growth, which is expected to come in on the second revision unchanged for Q2 at 2.4. So a surprise here. If this number even comes in higher than that, at that time, that could be moving the market because it would imply the Fed has even more work to do. We get information about income and spending. That directly reflects what's expected in the retail consumer spending. And then we'll get labor market information and manufacturing information to round things out. It is extremely consequential. The speech that happened from Jackson Hole on Friday, where Chairman Powell came out with, the hawkish view that inflation is not anywhere near where they want it. They acknowledge that they have more work to do and that inflation and fighting it is their number one priority at the moment. What was expected by Wall Street analysts and the media was a much more dovish statement that, hey, everything's good for now. We can pause and see what happens. Instead, the rug was pulled from that view unceremoniously. Had a pretty rough day, although the market recovered and closed higher for the day. And that's telling. What that again just reinforces the idea that, hey, this is not that great in the normal context, but in the context of the fact that companies appear to be doing well despite inflation, we're okay with that for a stock price perspective, and therefore stock prices might be able to hold this bullish configuration throughout the end. So that kind of ends it for stocks for now. Want to come in and look at rates on Federal Reserve, or on the U.S. Treasury, and these are high. So 1 month rate is 5.56. That's pretty much in line, just a little bit more than the Fed rate right now. 1 year paper, 5.4. We get out to 5 years and it's only 4.4. And 10 years is 4.25. Now, when we look at 10-year paper, what we are seeing is long-term inflation expectations. You think of it like a break-even rate, whereas if you were an institutional investor and you want to own the risk-free asset, you only have to worry about inflation. There's no default risk in the United States. Despite headlines to the contrary, it's considered in investment models to be a risk-free asset. Therefore, the only thing that you need to hedge against is inflation. So if I expect inflation to be 4.4% over 10 years, that's what I want as my rate in order to break even. And investors will buy treasuries up to that rate and then no more. And that's where it stands. So that suggests that the longer-term inflation expectation is anchored somewhere around there. Be that as it may, it does say that the Fed's going to continue to get things, be aggressive. They're going to be keeping rates high over the near term, and that it might not be as effective as what was thought a month ago, or even, I'm not showing it here, but a year ago. This is still a great environment for income investors, particularly those who want to own treasury bonds, and we've actually looked at treasury bonds across the board recently in a manner that hasn't been done in a very long time. Looking into corporate bonds, which is more of where we operate, yields are fantastic for income investors. 10-year paper at 5.4%. 5-year paper at 5.13. In fact, across the entire curve, we don't get below 5%. And that's doing retail investors and savers a very good deed, because they're able to get more income on their income investments. And the investors who are using bond exposure to hedge away some of their equity risk are getting paid more to do that as well. So this is a good development. All in all, we see a pretty robust market, and we're in it for the longer haul. So we're going to do what we do here all the time, and we're going to zoom back out 20 years and say, this is the type of viewpoint we want to be looking at, not the shorter term. We don't want to be making decisions to change a long-term, well-thought-out plan based on short-term information. And just to highlight, like we do, here's 2008, where we thought the entire financial system as we know it was going to be destroyed. Here's COVID, where the entire social system looked like it was going to be destroyed. And yet we worked that out. Here's the bear market of 2022, which was probably the more significant one in recent memory, and then the subsequent recovery. But we're in it for the long haul. You know, your period as an investor is 5 years, 10 years, 20 years. That's the view we need to take, and this plan is designed to do well and achieve goals over the longer term. With that said, if you're having questions or concerns about your portfolio or the markets or the economy, reach out to the team, and we're happy to help. Thanks. Hope you've enjoyed the video. Have a great day.